Hi and welcome everyone to our Global Investment Outlook Update for 2026. I'm joined by Naasha Kamani. Hi Naasha.
Hello.
Welcome.
Thank you.
Who's a lead associate in the investment strategy team at Willis Towers Watson, based out of Australia, Sydney. Naasha has a Bachelor of Commerce in Finance and Economics and investment strategy teams responsible for directing investment strategy across government, endowment funds, large industry super, corporate and retail funds across Australia. That's a mouthful, mate.
Yeah, I'll say that.
Anyway, welcome. It's great to have you here.
Thank you.
As we just talked through today, we're going to spend a little bit of time working through how things have gone in the last 12 months. And then I guess Willis Towers Watson's view of what the future looks like in terms of economics, and then an investment outlook update, which will follow. So it's great to have someone of your capability here, and we appreciate your time. So thank you.
Oh, it's good to be here.
All right. So first up, I might kick off if you like. So
Yep.
I'll take us through the investment portfolios and sort of what's happened over the course of the last 12 months or so to the end of December. So as all our clients will know, the way that we run investment portfolios, we've got a fairly strong set of beliefs which we built over the years, and then particularly with Willis Towers Watson a few years back. Diversification is key across a number of different asset classes, but not over diversification. We want to reduce the level of fees in portfolios. We have a preference for what we call evidence-based investing. So we've used the SPIVA reports, and the evidence there sort of suggests that low-cost implementation certainly works for our clients and our investors. We have a strategic asset allocation that we follow, of course, and we invest with a long-term mindset. Now, if we just run through quickly the performance of some of the portfolios. Just now talking about the Lifestyle Model 1 portfolio, which is, I guess, the extremely defensive portfolio. It's invested entirely into Australian and international fixed interest and cash, which is essentially bonds. And the portfolio aims to outperform the RBA cash rate, which is currently 3.85%, by 0.25%. So essentially getting the RBA cash rate plus a little bit over rolling 2-year periods. The portfolio itself is primarily invested in bonds, both Australian government bonds and corporate bonds. Whilst geographical location, it's mainly held in Australia. In terms of the performance, there were some issues during COVID, which is what we can see through this section here, where bond markets actually and bond valuations fell significantly. Since that period of time, which was around 3 years ago, a bit longer now, you can see it's hitting its cash rate objective, which is that 4.8%, which is what it's done in the last 3 years, versus the cash rate, which is at 4.4. Longer term, since inception, it's 2 versus 2.5, so it's kind of hitting very close to hitting its investment objective since inception, which has now been 7 years. So that one's going along pretty well, and it's clearly that's for a certain portion of your portfolio, depending upon your overall investment objectives and needs. Lifestyle Model 3 portfolio that invests in a diversified range of asset classes again. So we have around about 50% of that portfolio in defensive assets, and we have the 50% of the portfolio in growth assets such as Australian international equities, property. The expected return there is the RBA cash rate plus 2.75 over a rolling 3-year period. We have a look at some of the names there. Top equity holdings: Nvidia, largest company in the world; Microsoft, Combank, BHP, Goodman Group, Alphabet is Google, of course, Westpac Bank. So a lot of those names should be familiar in terms of the equity holdings that we hold. And then the portfolio performance itself, that's been really strong, actually. So since inception, which is coming up plus 7 years now, the return there has been 7.2 versus the expected return, which is the investment objective, which has been 5. The 1-year numbers, again, looking really strong, 8.4 versus 6.9, 3 years, 10.4 versus 7, 5 years, 5.9 versus 5.6. And I think you can see there with the growth of $100 since inception is that we sort of continue to keep outperforming that line. and then it pulls back a little bit where markets have a bit of volatility and then outperforms again. So we've been really pleased with the performance of those, of Lifestyle Model 3. The Lifestyle Model 4 portfolio, which I'll jump into now. So the Lifestyle Model 4 portfolio has 70% allocated to growth assets and 30% allocated to defensive assets. Growth assets are Aussie equities sit around about 18% in that portfolio, and the global equities sit around about 37% currently, with then further allocation to listed property, listed infrastructure, both global, and a little bit in emerging markets. So the portfolio itself, as you can see here, that it's expected to achieve an investment objective, which is the RBA cash rate, again 3.85 plus 3.25% over a rolling 5-year period. So it's important because we have a lot of clients that need that sort of return to ensure that they are able to meet their own personal objectives when they're either growing their wealth or drawing down their wealth in retirement. If we jump into the portfolio performance, I mean, as you can see here, the portfolio performance has been excellent. So since inception numbers, been 7 years now, that's 9.5% per annum versus the benchmark, the investment objective, which is the RBA cash rate, 3.85 plus 3.25, since inception is 5.6. So it's being able to deliver significant performance above the investment objective is really important to us, and we're really proud of that, in fact. Looking at some of the other numbers here, so the 1 year's 10.4 versus 7.4, 3 years 12.6 versus 7.6, and then the 5 years 8.5 versus 6.2. So overall, the portfolio performance has been excellent out of Lifestyle Model 4, and we're obviously looking forward for that to continue. And then Lifestyle Model 6, which is 97% invested in growth assets. That portfolio again has had excellent returns because it's been a great time for financial markets. So total returns currently sitting about 12 over the investment time frame since inception, so 7 years, versus the RBA cash rate investment objective plus 4% is about 6.4 over that same time frame. So it's been a very good time to be invested. We don't know that's going to continue, obviously, but it's been a very good time to be invested. Now, finally, what I've just done here is give people an understanding of the portfolio performance versus peers. This is some research that's come from Lonsec, which is a provider that we use that measures performance of all the funds out there. And again, over each time frame, 1, 2, 3, 5, 7 years, you can see the portfolios have had top quartile performance. So we're really proud of the portfolios. It's been a good time to be invested, and that is true, but we're really proud with how we've built these, and looking at using a strategic asset allocation as a framework, using a low cost implementation has really worked for our clients, and so we're just really happy that they're going well with Willis Towers Watson's support. Okay, so I've done my part, Naasha. It's over to you now.
Perfect. Thanks, Cam. So thanks for having me over to discuss the global investment outlook from W2W's perspective. There's definitely no shortage of things to talk about in the current context.
No, that's right.
If we look at the structure of the presentation on the next slide and the content, it's essentially structured into two. So I'll go over some of the major economies that we look at, US, Euroland, Australia and China, looking at what happened in 2025 and our outlook for 2026 as well. With that context, we'll jump into some of our asset class views for government bonds, credit, equities and foreign exchange, both globally, but then also providing that Australian context as well. Perfect. So having said that, let's jump into the United States, obviously the biggest global developed market economy, and a lot going on in 2025. So overall, at a higher level, economic growth proved more resilient than we actually expected at the beginning of the year for the United States. And that really comes off pretty much, a multitude of factors, but really a more resilient household sector actually driving growth and continue to spend in what would be quite an uncertain environment in 2025. But then also this environment of continued business investment, particularly in that technology and artificial intelligence space over that 1 year horizon is essentially where we've seen the most amount of growth come from in that economy.
Yep.
Having said that, on the flip side of that, tariffs again were a big component of the year as well. So you can really see in that chart on the top right of this slide, we essentially went from an effective tariff rate in the United States for exports into the United States from 2.3% in the beginning of the year to something closer to 15%. So quite a remarkable jump over the extent of that year, pretty much off the back of President Trump's Liberation Day tariffs that we saw in April.
And it was such a significant time in global financial markets at that time, wasn't it?
Exactly, yeah. And, as you say, such a significant time and so much uncertainty derived out of that one particular moment, off the back of that, economists were coming out and saying, we don't exactly know how households are going to react, how businesses are going to react, whether they can actually plan into the future. Just because the guidance wasn't necessarily too strong as well from the United States, it was quite, sporadic at the time. Having said that, uncertainty has settled back by the end of the year to some degree. We've got some truces between the United States and some major players, namely China and Europe. But also, something that does characterize 2025 is because of this tariff situation, inflation essentially sort of proved to be more sort of on the upside throughout the year. And we had this re-inflationary environment, and that really put the Federal Reserve in a tough spot where they had to balance one side of their mandate, which is inflation, and the other side of their mandate, which is growth and labour market. And what we eventually saw was that they pretty much favoured the latter side of that mandate, so the labour market side, and they induced 3 rate cuts within the economy. And some of them were even characterised as risk management cuts. So, we know inflation's still high, but we have to cut the Fed fund rate in order to sort of not see the labour market deteriorate extensively. If we take a look now at 2026, well, a lot of the positive growth factors that we've seen in 2025, we expect to continue with momentum in 2026. So in terms of a headline growth number, we've penciled in 2.5% for 2026. And the two things that I would say on that number is that firstly, it's above trend and it's also above consensus. So we have a more positive view, if you like, on the United States economy in 2026, really off a couple factors. So firstly, we think there's going to be continued fiscal expansion within the economy. So, President Trump came out with the budget reconciliation bill mid-year last year in 2025. And we're expected to see some of those tax cuts still coming in and flowing into the market in 2026. That's going to help the consumer and they're going to remain a big part of the outlook going forward as well. But then also, if you look in that chart, under the table there on the left, the capital expenditure chart, that's resembling the capital expenditure from the top 6 US cloud companies in terms of their forward guidance. And pretty much we don't even have to look at the numbers, but we could just look at those columns and see that it's going to be quite exponential over the next couple of years. So I think that's 40% growth into 2026 and then another 40% into 2027. So off the back of that, we expect business investment to drive the economy forward, particularly in that artificial intelligence space. And then some of the repercussions of that are not going to be only economic growth, but also productivity as well. So a more of a long-term effect whereby the labour market doesn't necessarily need to expand so rapidly in order to see growth continue to rise, because productivity is going to be enhanced within the economy, which is that really sweet spot that you like to be in terms of the economy. Having said that, in terms of the inflation outlook, so we do expect inflation to remain above trend and above the Federal Reserve's target in 2026. And overall, we expect in that environment of upside risks to growth and also upside risks to inflation, the Federal Reserve will essentially not be in a position to cut rates meaningfully like they did in 2025. So we're penciling in one more rate cut for the United States in 2026, and I think that's slightly less cuts than what the market or consensus is looking at currently. So what does all that mean for that our market's view? So essentially, positive growth, fiscal expansion, and relatively loose monetary policy is going to be good for equities.
Yep.
Whereas bonds may struggle slightly in that environment as you see sort of yields correct upwards and then prices fall. So we're really looking at equities as the driver of returns going forward.
Mm. Yeah, it's an interesting one, that, isn't it? Because I know when we speak to clients about that, clients' questions are around, it's been really great for a while now,
Right.
3 years plus, right? US equities have been excellent in terms of returns. And so we're continuing to see that. But
Yeah.
what's actually really interesting to me about that, and which is kind of what we've been chatting about previously, is that is coming from essentially domestic demand
Right.
within the US, and capital expenditure is still going to be significant, and so subsequently GDP growth is going to be actually okay.
Exactly. Yeah.
Which has been the question for a while, but it's great to see that the US economy is still going well.
Yes, it certainly is, and that's not to say that there isn't risks to the outlook.
Of course, yeah.
As there always are. So
It'd be an economic update without the risks.
I have to highlight them, but we are looking at US policy. We obviously know that it's been unpredictable
Yep.
in the current environment.
Yeah.
So there is going to be ongoing uncertainty from that landscape, but then also how inflation manages compared to the labour market. Again, thinking about the dual mandate of the Federal Reserve, how those play out is going to be really key as to whether they can continue to cut or not. So those are currently the main things we're looking at, and also how well this ongoing capital expenditure, we know that it's going to be a lot, that's for sure, but how well that actually translates to productivity and economic growth is going to be one of the big risks and one of the big factors that we need to look at as well.
Sure, makes sense.
Cool. Let's jump over to Euroland now. So in 2025, again, pretty similar to the United States actually, European economic growth proved to be more resilient than expected at the beginning of the year. And that was despite some headwinds that we had. We obviously mentioned the tariff situation with the US, Europe was entwined in that, but then also rising competition from China. So, as the Chinese economy looked to reroute a lot of their exports away from the US to other areas, that meant higher competition for the European exporters as well. So an environment that they had to sort of battle through. But we expect overall economic growth in 2026 to be fairly in line with what we saw in 2025, so around 1.2% for the year, which is in line with what consensus is looking at. Thinking about the inflationary story in Europe, well, it's proved to be, as the European Central Bank looks for. So inflation's running at 2%. It's made its way down to what the target level would be for the European Central Bank. And that means that they've essentially cut their policy rate to what they see as neutral and what we see as, remaining the policy rate for the foreseeable future at 2%. In terms of our outlook and what the key things that we're looking at, well, Europe's obviously made up of a lot of economies, right? So the main one that we're looking at is Germany. So Germany's actually come out with quite an aggressive fiscal package over the last couple months and quarters. They've highlighted ongoing spending in terms of infrastructure and defense spending. So that's going to be one of the key factors that we're looking at to drive, firstly, German growth, but then also broader European growth as well. But then what has remained resilient in 2025, and we expect to remain a key driver going forward in 2026 as well, is overall domestic demand.
Right.
Household spending, the policy rates drop, so we're expecting incomes to rise and spending to continue as well in that environment. Very similarly to the US, because of that macro environment that I've highlighted, we think equities are going to do well off the back of the fiscal expansion, the monetary loosening, and the ongoing investment in AI. Whereas, bonds may struggle in that environment if we do see a correction in yields to the upside.
Sure.
Shifting over to the domestic economy, Australia. So what we saw in 2025 was essentially economic growth in Australia bounced back from relatively low levels over the first half of 2025 and particularly 2024 to something that would be considered more in line with trend growth. So we've currently got economic growth roughly around 2%. And what we've seen in terms of the dynamics of what's driving that growth is the private sector is actually picking up a lot of the slack. So if you recall, looking past in terms of 2025 and 2024, the economy was pretty much kept afloat by public demand, so government spending, keeping the economy afloat. But we think going forward, and what we've seen so far over the last couple of quarters, is that the private sector, so in terms of household spending, business spending, that's picking up overall economic growth in the economy, which is a positive thing to see. It means households aren't necessarily doing as bad as they used to be in the economic environment.
Yeah, interesting in the context that we just had a rate rise. So,
right, exactly right. Yeah, and that brings me to my next point. So,
nice
nice little segue there. If you look at that chart right in the middle of the slide, you can see over the last couple quarters, over the last couple of years rather, Australia's economic growth has largely been driven by population growth. Yeah, and as I've just mentioned, you can't see that in there, but public demand, so government spending.
Yes. Yep.
And what you can see also is that real GDP per capita has been pretty much flat. And that's because our productivity in the economy isn't necessarily doing too well. It's essentially gone nowhere over the last decade. So you have people coming into the economy through population, that's expanding the economy, which is economic growth at the headline, but the people within the economy who are existing in the economy aren't producing more. It's just more people coming into it, if that kind of makes sense.
But as productive as we were 10 years ago.
Yes, it's a pretty dire situation in that sense, but and that's pretty much leading us to your point that you just made and why we're seeing this bounce back in inflation in Australia, because productivity is not there. The capacity for the economy to absorb this bounce back in aggregate demand isn't there. So therefore we're seeing capacity pressures being pushed and ultimately inflation overshooting the Reserve Bank's target of 2 to 3%.
Yeah.
And why the Reserve Bank came out in February and had to hike the cash rate by 25 basis points in order to tame inflation.
And I guess one of the questions that I know our clients will have is, how likely is that to persist?
Yep.
Increased inflation. Subsequently, are we now thinking about there might be an additional interest rate rise?
Yeah, I mean, it's certainly a great question and something that we've been looking at in quite a lot of detail. So our view is that overall, we expect inflation to come back within the Reserve Bank's target range of 2 to 3% within 2026. The factors behind that suggestion is that we expect this 125 basis point hike in the cash rate off the back of, keep in mind, some sustained easing over the last couple of years. But the fact that we've moved so quickly into a rate hike, the fact that Australia is highly indebted, we have high amounts of household debt.
Has a significant impact straight away.
Exactly right, exactly right. We also, there's other things at play as well. So we have overall forward guidance from the government, although it's quite uncertain at the current moment when we're looking at the May budget for this, is we expect fiscal policy to move from something that's been quite expansionary over the last couple of years, as I've mentioned, to something more neutral. Yeah. So that should hopefully, not add too many inflation pressures there. But then also we've seen this sustained increase in the Australian dollar, which actually has this effect where it makes imports into Australia cheaper. So imported inflation is actually lower as well. So we've got this de facto tightening from the Australian dollar as well to consider. So having said all that, we have the view that the Reserve Bank will hold the cash rate at 3.85% in 2026, but they'll remain very much data dependent and cautious going forward.
Yeah.
And they'll look at the data as it comes.
So on that basis then, and correct me if I'm wrong,
Yeah.
because it happens, that I'm wrong. On that basis then, I think that they're suggesting that we'd start to see the CPI numbers start to come down as a result of that one rate hike that we've seen.
Yeah, that's right. Yeah, maybe not in the the next
Sure.
read we see,
Yeah.
the next quarterly
Well,
read.
they're so, they're,
Yeah, maybe by the end of the year, it will start creeping back towards
sure.
that target. Having said that, the risks do remain on the upside for sure. So if we do see aggregate demand continue to be strong, government spending continues to be strong, as I mentioned, the Australian economy doesn't have the capacity to absorb that strength in aggregate demand. So inflation will continue to overshoot and the Reserve Bank will need to jump in and continue to hike rates. So that's currently the environment that we're facing in Australia.
Great.
Perfect. Shifting over to China, so an economy which is very much related to Australia. In 2025, we did see, the Chinese economy overall hit their 5% target. So they've set this target for 5% GDP growth over the last couple of years, and they essentially hit that target in 2025, pretty much coming off the back of what was strong government support for domestic consumption, but then also their manufacturing industry doing relatively well as well. What we did see in China as well, and you may highlight this is a theme that we've seen pretty much in all the economies looked at, but this ongoing trade tension between the US was a key component of the Chinese economy in 2025. What I would say to that is that the Chinese economy pretty much came out of that unscathed. So if you look at the chart in the bottom right there, you can see that overall exports to the US slipped considerably for China, but overall global exports remained positive in the year. So an indication that they were successfully able to reroute a lot of their exports away from the US towards other regions, which I guess is a positive factor for their economy. In terms of the economic strategy going forward, the things that we're looking at is an ongoing emphasis on tech reliance, this competition that they have with the United States in terms of developing their artificial intelligence capabilities. Semiconductors is going to remain a key component of that. Consumption as well. The Chinese government's addressed the fact that they would really love to see the consumption within the industry, the economy driving growth going forward, as opposed to government spending. But overall, those are sort of the factors that we're looking at. In terms of the growth figure that we're looking at in 2026, slightly less than that 5% target that the government looks for, but higher than what consensus has at 4.5% in 2026. Cool. So that's the economic update.
So I guess the key question then is, how does all that impact expectations of asset classes?
Exactly, yeah. So applying that investment landscape context is very important, which brings me to one of the asset classes that we look at, global government bonds. So, just highlighting what happened in 2025, I think is good to provide that context. So we essentially saw this, divergence in global government bonds, whereby certain economies, namely the UK and US, saw a fall in their government bond yields, whereas certain economies, Australia included, but Japan as well, saw a rise in global government bonds in 2025. Overall, what we're expecting for global government bonds is that yields will remain very much sensitive to economic data and policy, particularly coming out of the US, and the implications that will have on inflation, but then also other factors like the labor market and those economic fundamentals. We expect the market to react as they come through. Having said that, we do see select opportunities in certain markets for global government bond yields where we don't necessarily see as many rate hikes as the market's pricing in, or we see more rate hikes that the market's pricing in. We think there's an opportunity for yield correction there. But overall, the messaging within this slide is that strategically, government bonds still have a place within portfolios to add diversity, to have the downside risk protection opportunity that they offer. But obviously, risks do remain in the current environment. Shifting over to government bonds from an Australian perspective. So I noted that we do have a positive view on certain economies where we don't see the central bank rising the Fed fund rate or the cash rate as much as the market's expecting. That's the case for Australia. So you can see pretty much off the back of some of the inflation reads that we've gotten recently, the market's done a bit of a 180 in terms of what they're pricing in for the cash rate, right? So they've gone from looking at the cash rate closer to 3% to back to 4.2, 4.25%, which is essentially 2 hikes from where we are now.
Yeah.
We're slightly more cautious than that. We're not as pessimistic as the market. We think that the RBA, as I said, will remain data dependent, cautious, and they'll keep the cash rate at current levels. And off the back of that, we do see opportunities in government bonds in Australia, given the elevated yields that they offer compared to our global peers.
Yeah, rest of the world. Yeah,
exactly.
That's right.
Yeah. So that's why we have that positive view in the short term, but that shifts to neutral in the medium term. An asset class which is closely related to government bonds, we're looking at credit now, which is bonds issued by corporates. Well, what we saw in 2025 was this ongoing trend that we've seen over the last couple of years, really, where credit spreads have tightened compared to government bonds, particularly. So the yields that corporate bonds offer against government bonds has contracted considerably, which you can see in those charts there. And based off that view, we essentially hold the view that essentially the compensation which is offered by corporate credit investment grade bonds remains relatively tight. So we have this negative view on them, coupled with the fact that supply pressures do exist. So I mentioned this ongoing capex infrastructure spending and ongoing sort of AI theme. That ongoing capex needs to be funded somehow, and we think corporates will need to continue to spend in terms of they'll need to continue to issue debt to fund that capital expenditure, which means that we may see an upside to yields, downside to prices, and therefore we hold that negative view on credit in the short term.
Got to get the money from somewhere, don't they?
Exactly right. Exactly right. Shifting over to Australia now. So, the overall sentiment here is that we're pretty much consistent with what the global view is. So, spreads have tightened in 2025, but if you look at that chart on the bottom right there, credit spreads in Australia do remain elevated compared to the United States in particular. But what you can see is that that's been a sustained spread against the US. And essentially the point that I'm making is that that's because of structural and technical factors within the economy, not weaker fundamentals. So, Australia's market's relatively more illiquid, it's smaller, so the compensation it offers is relatively higher. But overall, we retain a negative view on investment grade credit in the short term, but over the medium term, that view moves to neutral. Equities now. So what we saw in 2025 was positive performance for developed market equities. So a return of 18.9% is very good.
Extraordinary.
Yes, very good, especially compared to long-term averages, if you think about it, of around 8 to 10% per annum. 18.9% is a very good return. So that's one thing to note. Emerging markets performed even better. So they returned 32% in 2025, largely driven by some pretty strong performance in Asian economies, particularly Korea and Taiwan. But in terms of the broader trends, and this really underpins this positive view that we have over the short term, we expect ongoing AI investment and ongoing earnings growth in some of these big tech companies in the US to drive earnings potential and overall returns in the short term. We do expect fiscal and monetary policy, as I've mentioned, to remain expansionary as well, to sort of supplement that earnings growth. So that really underpins, our forward-looking positive view on equities. But having said that, I think it's important to note that risks do remain, as we sort of highlighted in the first slide, I think, that, this ongoing trade uncertainty, the unpredictability of policy does remain. But we just think that just bolsters the reason to remain fully diversified, having those downside risk hedges within the portfolio, but also having that attractive exposure to equities.
And what would you describe as some of the risks?
Yeah, so the risks, I mean, the tariff situation, how that develops, it has been quite erratic. We have a truce, but it's a short-term temporary truce between the US and China. So if that inflates again, we may see a retracement in markets. Keep in mind, when I say retracement, we're talking about short-term retracement. We think the market will correct, but then it'll make back those gains in relatively a short time frame. But then also, those risks that I highlighted in relation to, we're seeing a lot of capital expenditure. There's no doubt about it. AI is a big theme within the economy. But whether that can actually translate well to economic growth, earnings growth, and whether the demand's there to absorb that supply of AI, and how cleanly that absorption happens, is one of the key things that we're looking at, which could be a risk as well if it doesn't sort of translate like we're seeing. But again, their risks are base view is that equities are going to perform well over the next 12 months.
So it sounds to me like the view, just in terms of AI and the productivity gains that the economy gets as a result of AI.
Yeah.
Willis Towers Watson's view is that there is that will play out as the market sort of expects.
Yeah.
And subsequently, with those large tech companies will continue to see earnings growth, which they have so far. As a result of that, is that fair?
Yeah, that's fair. Yeah, that's pretty much our view. I mean, it's too early. Keep in mind, we're relatively early in the AI investment cycle.
Yeah.
So, we're still yet to see exactly how things play out. We don't know, it's too early to tell whether the demand's going to fully be there, but our view is that it is going to be there, and, we're going to see this nice absorption within the market, which is going to lead earnings growth, and, we're going to see some pretty strong performance going forward.
Excellent.
Good.
Can I bring up Donald Trump?
Yes, go ahead.
I only bring it up because every single conversation I have with our clients is there's questions about the US president. So from our perspective, what we see is because of his more volatile nature relative to other US presidents.
Right.
There's a little bit more market volatility.
Mm-hmm.
Is that fair? Is that something that is? Would you agree with that?
Yeah, that's fair. I mean, and that's one of the risks. I think it's even highlighted in this slide here, that policy does remain sort of very unpredictable, and it is, it could be a headwind if, it translates into more erratic policy developments. President Trump sort of changes course on a couple of things. Things could change quickly, right? So what you've just highlighted, I think, is definitely, how we're looking at things as well. But having said that, the flip side of that is we do see his fiscal policy as being expansionary, as one of the key forces that's driving this growth that we're talking about. So, there is two sides of the story as well. But as you mentioned very rightly, you have to be cognizant of the fact that there is risks in the current administration.
And I think perhaps reflecting more broadly, having a diversified investment strategy works in that instance, right?
Yep.
Because you have the diversification impact. But then also the volatility seems to me thus far to be short-term volatility.
Yep.
So you see the short-term volatility, and importantly, I see that the medium-term 3 to 5 years, the asset class view for global equities is neutral, which means it's okay.
Yeah.
But what we've seen so far is short-term volatility, both up and down.
Yeah, that's right. Yeah. It's been one of the key characteristics of the current market, not just from the policies that we're seeing out of the US. You've got ongoing geopolitical issues globally.
Yep.
And what we've seen really is that markets, they do react, but the reaction is very short-lived, as you say, and they do tend to make those gains back. So that's just the context that we're living in currently. Markets are taking the news kind of in their stride and looking through it to some degree. But as you say, you do have to sort of note that we are at a time of heightened uncertainty. That's good to note as well. Yeah. Overall, Australian equity performance in 2025 did actually underperform global peers. So
quite significantly, actually.
Yeah, exactly. So we got a return of 10.3% in the year, which is lower, considerably lower actually compared to what we just highlighted on the previous slide.
Yep.
And what we're seeing in that chart, because of that underperformance, that chart on the bottom left there is essentially, looking at relative valuations between Australia and the rest of the world. Australian equities remain cheap because they've underperformed. Essentially, that's the
relative to the rest of the world.
Exactly. Yeah. Yes. Good to know. But on the flip side of that as well, Australia isn't necessarily exposed to a meaningful degree to some of those themes that we're looking at, which are really going to drive our positive performance in terms of the global equity landscape. So, that AI theme, the Australian economy, the Australian equity market isn't necessarily well aligned to a certain degree, but then also that fiscal and monetary support that I've mentioned that we're seeing in the United States, Europe, Japan. Australia is probably moving actually from what's been expansionary to a more neutral landscape in terms of those levers. So we don't sort of see that sort of theme alignment for Australia, and therefore we retain what is a neutral view over the short term and the medium term.
Understand.
Just finally now, if we take a look at foreign exchange, there's a lot of economies that we look at in terms of foreign exchange, but what we've seen really in 2025 has been this actual sustained weakening in the USD compared to a basket of economies, pretty much all the global developed market economies. And Australia's very much benefited from that. So we saw a 7.7% return against the USD in 2025. Year to date, that's continued in 2026. So 5% year to date performance, pushing the AUD close to 71 cents compared to the USD, which is, being good performance. And, the reasons behind that is this ongoing sort of macro uncertainty, elevated equity market volatility as well. Things which actually, if you consider it, used to actually favor the USD because of it, its risk-off characteristics, have actually weighed on the currency in recent times because of the US-centric nature of those risks. As you've mentioned, the US administration being a key part of that. But then also what you're seeing as well, which you can see in that chart on the bottom right there, is that 2-year interest rate differentials are sort of moving away from the US to be more positive for other economies. So, for example, if you look at Australia, the 2-year government bond yield is actually greater than the 2-year government bond yield in the US, which means essentially, the compensation you're offered for investing in Australian government bond yields is greater than the US. That increases demand for the AUD, and that overall obviously increases its appreciation.
Yeah, that makes sense.
Despite that that performance, we still view that the USD is overvalued against the basket of global developed market currencies, including Australia, and therefore we have this kind of longer term structural positive view that a lot of the things that we've just talked about are going to continue to play out, benefiting developed market currencies against the US over 3 to 5 year horizon.
Yeah, great. And look, finally, Naasha, obviously the disclaimer up here, which really says that past performance is no indication of any future performance. You need to take into account your investment objectives, financial situation or needs, and get qualified advice from a qualified financial advisor, most likely being independent wealth partners.
That's right, yeah.
All right, well, look, thanks so much, mate. That's been a great update. Yeah, so we've really appreciated your time coming in, and it's great to hear Willis Towers Watson's views of investment markets, financial markets, and the global economy. So thank you.
My pleasure. It was great to do that, and it's great to speak to you.
Cheers.